Question 1. Cost-benefit analysis shows that streamlining the approval process for customer communications could lead to faster market penetration for new corporate securities. Which approach best balances the potential benefits of speed with the absolute priority of regulatory compliance under the Series 62 exams jurisdiction? Option A. Develop standardized templates for common communication types that have been pre-approved by the Compliance Department, allowing registered representatives to populate them with specific offering details, subject to a final compliance check before dissemination. Option B. Expedite the review process by allowing registered representatives to disseminate communications immediately upon their own assessment of compliance, with a post-dissemination review conducted by compliance within 30 days. Option C. Rely on the issuer's internal compliance department to pre-approve all marketing materials, with the firm conducting only a cursory review to ensure basic alignment with the offering prospectus. Option D. Implement a tiered review system where less complex communications are approved by senior sales staff, while complex ones go to compliance, ensuring all approved materials are filed with FINRA within the required timeframe. Correct answer is D. Implement a tiered review system where less complex communications are approved by senior sales staff, while complex ones go to compliance, ensuring all approved materials are filed with FINRA within the required timeframe. Explanation. This scenario presents a common challenge for registered representatives, balancing the need to promote investment products with the strict regulatory requirements for communications with the public. The core difficulty lies in ensuring that all promotional materials are fair, balanced, and not misleading, while still being effective in attracting potential investors. This requires a deep understanding of the Securities Act of 1933 and the Securities Exchange Act of 1934, as interpreted by the SEC and FINRA rules governing advertising and sales literature. The correct approach involves a thorough review process that prioritizes regulatory compliance and investor protection. This means ensuring that any communication accurately reflects the risks and potential rewards of an investment, avoids hyperbole or guarantees, and includes all necessary disclosures. The regulatory framework, particularly FINRA Rule 2210, Communications with the Public, mandates that firms establish and maintain procedures for the review and approval of communications. This includes ensuring that communications are fair, balanced, and provide a sound basis for evaluating the investment. The ethical imperative is to act in the best interest of the client, which is directly supported by adhering to these communication standards. An incorrect approach would be to prioritize speed or sales volume over accuracy and completeness. For instance, disseminating a communication that omits material risk disclosures or makes unsubstantiated claims about performance would violate the spirit and letter of securities regulations. Such an approach fails to provide a sound basis for investment decisions and could lead to investor harm, resulting in regulatory sanctions and reputational damage. Another incorrect approach would be to rely solely on the issuer's marketing materials without independent verification or consideration of the specific audience's sophistication, which also risks misrepresentation. Professionals should adopt a decision-making process that begins with a clear understanding of the applicable regulations. Before any communication is disseminated, it should undergo a rigorous internal review by a qualified compliance professional. This review should assess the communication for accuracy, completeness, fairness, and balance, ensuring that all claims are substantiated and all necessary disclosures are present. The process should also consider the intended audience and whether the communication is likely to be understood by them. If there is any doubt about compliance, the communication should be revised or not used. Question 2. Risk assessment procedures indicate that a client is considering an investment in a financial instrument that represents a direct ownership stake in a corporation. This instrument typically grants the holder voting rights in corporate matters and entitles them to a share of the company's profits, distributed as dividends, though these are not guaranteed. The holder's claim on the company's assets and earnings is residual, meaning they are paid only after all other creditors and preferred stockholders have been satisfied. Which type of corporate security is most accurately described? Option A, warrant. Option B, common stock. Option C, preferred stock. Option D, bond. The correct answer is B, common stock. Explanation. Scenario analysis. This scenario presents a challenge for a Series 62 representative because it requires them to distinguish between different types of corporate securities and understand their fundamental characteristics, particularly in relation to investor suitability and risk. Misidentifying or mischaracterizing these securities can lead to inappropriate recommendations, regulatory violation, and harm to clients. The representative must apply their knowledge of the Securities Act of 1933 and the Securities Exchange Act of 1934, as well as FINRA rules, to correctly classify and explain these instruments. Correct approach analysis. The correct approach involves accurately identifying the security as a common stock. Common stock represents ownership in a corporation, typically carries voting rights, and offers the potential for capital appreciation and dividends, but also carries the highest risk among equity securities due to its residual claim on assets and earnings. This aligns with the definition and characteristics of common stock as tested in the Series 62 exam, emphasizing its fundamental nature as an equity instrument. Incorrect approach is analysis. An approach that identifies the security as a bond would be incorrect because bonds represent debt obligations, not ownership. Bondholders are creditors, not owners, and receive fixed interest payments and the return of principal, with a lower risk profile than common stockholders. An approach that identifies the security as preferred stock would be incorrect because preferred stock, while an equity instrument, has priority over common stock in dividend payments and asset distribution, typically does not carry voting rights and offers a fixed dividend, making it distinct from common stock. An approach that identifies the security as a warrant would be incorrect because warrants are options that give the holder the right, but not the obligation, to purchase a company's stock at a specific price within a certain time frame. They are derivative instruments, not direct ownership of the stock itself. Professional reasoning. Professionals should approach such questions by first recalling the core definitions of various corporate securities. They should then analyze the provided description, looking for keywords that indicate ownership, stock, debt bond, priority rights preferred stock, or the right to purchase warrant. A systematic comparison of the described features against the established definitions will lead to the correct identification. This process ensures adherence to regulatory requirements for accurate product knowledge and client suitability. Question 3. Strategic planning requires a registered representative to evaluate the best way to present the complexities of a corporate security to a client. A client is considering an investment in a preferred stock that has a stated dividend rate, but also possesses several other features. Which of the following explanations best ensures the client understands the full implications of this investment, aligning with suitability requirements? Option A. Explain that the preferred stock offers a fixed dividend payment, which is a primary benefit for income-focused investors, and that the company has the option to buy back the shares at a set price. Option B. Focus on the fact that the preferred stock can be converted into common stock, which offers potential for capital appreciation, and that the company may call the shares back if interest rates fall. Option C. Emphasize the stated dividend rate as the main attraction, noting that it is non-cumulative, meaning missed dividends are lost forever, and that the stock is not convertible or participating. Option D. Detail how the preferred stock is cumulative, meaning missed dividends will accrue and must be paid before common dividends. It is also participating, allowing for additional dividends if company profits rise. It is convertible into common stock, and it is callable by the issuer, with the representative explaining the potential impact of each feature on the client's investment. The correct answer is A. Explain that the preferred stock offers a fixed dividend payment, which is a primary benefit for income-focused investors, and that the company has the option to buy back the shares at a set price. Explanation. This scenario presents a professional challenge because a registered representative must advise a client on an investment that has multiple features, each carrying different implications for the investor's rights and the company's financial obligations. The representative's duty is to ensure the client fully understands these features and how they align with their investment objectives and risk tolerance, adhering strictly to the suitability requirements under the Securities Exchange Act of 1934 and FINRA rules. Misrepresenting or failing to adequately explain these features could lead to a breach of fiduciary duty and regulatory violations. The correct approach involves clearly explaining to the client that the preferred stock is cumulative, meaning any missed dividends must be paid out before common stockholders receive any distributions. It is also participating, allowing preferred shareholders to receive additional dividends beyond the stated rate if the company's profits exceed a certain level. Furthermore, it is convertible, giving the holder the option to exchange it for a specified number of common shares, and callable, allowing the issuer to repurchase the stock at a predetermined price. The representative must ensure the client understands these rights and potential outcomes, linking them to the client's stated goals of income generation, potential for capital appreciation, and desire for flexibility. This aligns with the regulatory requirement to recommend investments that are suitable for the customer, considering their financial situation, investment objectives, and risk tolerance. An incorrect approach would be to focus solely on the stated dividend rate of the preferred stock, without explaining its cumulative nature. This fails to inform the client about the security of their income stream and the potential for arrears to be paid. Another incorrect approach would be to highlight the conversion feature without discussing the potential dilution of ownership or the impact on the stock's market price if converted. Similarly, emphasizing the call feature without explaining the risk of the stock being redeemed at a price that may not be favorable to the investor, especially in a declining interest rate environment, is a failure to provide a complete picture. Finally, neglecting to explain the participating feature means the client is unaware of the potential for enhanced returns beyond the fixed dividend, which could be a key benefit depending on their investment goals. All these omissions represent a failure to meet the suitability standards mandated by securities regulations. The professional decision-making process for similar situations requires a thorough understanding of all the features of any security being recommended. This understanding must then be translated into clear, concise, and comprehensive explanations tailored to the client's level of financial sophistication. The representative must actively solicit the client's understanding and address any questions or concerns, ensuring that the client can make an informed investment decision based on a complete appreciation of the security's characteristics and potential implications. Question 4. Quality control measures reveal that a registered representative has recommended a diversified portfolio primarily composed of large-cap U.S. equities to a client. The representative's internal notes indicate a strong focus on the potential for capital appreciation. However, when asked to elaborate on the primary risks associated with this investment strategy, the representative's explanation centered almost exclusively on the possibility of a specific company within the portfolio defaulting on its debt obligations. Which of the following best describes the most significant investment risks that the representative should have prioritized in their explanation to the client? Option A, credit risk and currency risk. Option B, interest rate risk and credit risk. Option C, market risk and inflation risk. Option D, currency risk and interest rate risk. The correct answer is C, market risk and inflation risk. Explanation: scenario analysis. This scenario presents a common challenge for registered representatives under the Series 62 exam jurisdiction, advising a client on investment strategies while managing the inherent risks. The challenge lies in accurately identifying and explaining the primary risks associated with a specific investment recommendation, ensuring the client fully understands the potential downsides before committing capital. Mischaracterizing or downplaying these risks can lead to client dissatisfaction, regulatory scrutiny, and potential financial harm to the client. Correct approach analysis. The correct approach involves accurately identifying and articulating the dominant investment risks present in the proposed portfolio. For a diversified portfolio of large-cap U.S. equities, the most significant risks are market risk and, to a lesser extent, inflation risk. Market risk, also known as systematic risk, is the risk of losses due to factors that affect the overall performance of financial markets, such as economic downturns, political instability, or changes in investor sentiment. This risk cannot be eliminated through diversification within the equity asset class. Inflation risk is the risk that the purchasing power of an investment's returns will be eroded by rising prices. While large-cap equities have historically provided some hedge against inflation over the long term, it remains a relevant consideration. This approach aligns with the regulatory obligation to ensure clients receive suitable recommendations and are fully informed about potential risks, as mandated by FINRA rules governing suitability and fair dealing. Incorrect approach is analysis. An approach that focuses solely on credit risk is incorrect because credit risk is primarily associated with debt instruments, bonds, and the possibility of default by the issuer. While some large corporations may have debt, The primary risk for a portfolio heavily weighted in their equity is not the default of the equity issuer, but rather the overall market performance. This mischaracterization fails to address the most pertinent risks for equity investments. An approach that emphasizes currency risk as the primary concern is incorrect in this context. Currency risk arises from fluctuations in exchange rates when investing in foreign assets, since the portfolio is described as consisting of large-cap U.S. equities. Currency risk is not a significant factor. Focusing on this irrelevant risk demonstrates a lack of understanding of the portfolio's composition and its associated risk profile. An approach that highlights interest rate risk as the most significant concern is also incorrect for a portfolio of large-cap U.S. equities. Interest rate risk is the risk that changes in interest rates will adversely affect the value of an investment, and it is most directly applicable to fixed-income securities like bonds. While rising interest rates can sometimes indirectly impact equity valuations by increasing borrowing costs for companies or making bonds more attractive relative to stocks, it is not the primary or most direct risk for equity holdings themselves. Professional reasoning. Professionals should adopt a systematic process for risk assessment. First, they must thoroughly understand the client's investment objectives, risk tolerance, and time horizon. Second, they must analyze the specific characteristics of the recommended investment or portfolio, including its asset allocation, geographic diversification, and the types of securities involved. Third, they must identify and prioritize the most relevant investment risks associated with that specific investment, aligning them with the client's profile. Finally, they must clearly and accurately communicate these risks to the client in a manner that is easily understood, fulfilling their fiduciary and regulatory obligations. Question 5. Governance review demonstrates that a registered representative is advising a client on the purchase of a corporate bond. The representative highlights that the bond pays a 5% coupon rate and matures in 10 years. The client is seeking an investment that provides a predictable income stream and capital preservation. Which of the following approaches best reflects a comprehensive understanding of the bond's investment characteristics for suitability purposes, beyond just the stated coupon and maturity? Option A. Emphasize that the 5% coupon rate guarantees a 5% annual return on the par value, making it a secure income investment. Option B. Focus on the maturity date as the primary factor, assuring the client that their principal will be returned in full after 10 years regardless of market conditions. Option C. Highlight the call provision, explaining that the issuer can redeem the bond early, which is beneficial for the issuer if interest rates decline. Option D. Explain the concept of yield to maturity (ITM) and how it reflects the total return an investor can expect if the bond is held until maturity, considering the current market price and reinvestment of coupon payments. The correct answer is A. Emphasize that the 5% coupon rate guarantees a 5% annual return on the par value, making it a secure income investment. Explanation. This scenario presents a professional challenge because it requires a registered representative to interpret complex bond features and their implications for a client's investment objectives, all within the strict confines of Series 62 exam regulations. The challenge lies in moving beyond a superficial understanding of bond terminology to a nuanced application of how these features impact risk, return, and suitability, particularly when considering potential future events like interest rate changes or the issuer's financial health. A registered representative must exercise careful judgment to ensure the advice provided is accurate, compliant, and aligned with the client's best interests, avoiding any misrepresentation or omission of material facts. The correct approach involves recognizing that the yield to maturity (ITM) is the most comprehensive measure of a bond's total return if held until maturity, accounting for the coupon rate, par value, and the current market price. It also implicitly considers the time value of money. This approach is correct because it directly addresses the investor's potential return over the bond's life, a critical factor in investment decision-making. Regulatory frameworks, such as those governing the Series 62 exam, emphasize the importance of providing accurate and complete information to clients regarding investment products. Understanding YTM allows a representative to properly compare different bonds and assess their relative attractiveness, fulfilling the duty of care and suitability requirements. An incorrect approach would be to focus solely on the coupon rate as the primary indicator of a bond's return. This is a regulatory and ethical failure because the coupon rate only represents the annual interest payment relative to the par value and does not account for the price paid for the bond or the time remaining until maturity. An investor buying a bond at a premium will receive a lower YTM than the coupon rate, and an investor buying at a discount will receive a higher YTM. Misrepresenting the potential return by highlighting only the coupon rate is misleading and violates suitability standards. Another incorrect approach would be to overemphasize the call provision without adequately explaining its implications for the investor. While a call provision allows the issuer to redeem the bond early, often at a premium, it introduces reinvestment risk for the bondholder. If interest rates fall, the issuer is likely to call the bond, forcing the investor to reinvest the proceeds at a lower prevailing rate. Failing to explain this risk and its potential impact on the investor's overall return, especially when discussing YTM, constitutes an omission of material information and a breach of fiduciary duty. A third incorrect approach would be to solely consider the maturity date without relating it to the bond's yield or other features. The maturity date is important for understanding when the principal will be repaid, but it does not, by itself, indicate the profitability or risk of the investment. Focusing only on the maturity date ignores the critical aspects of current market value, coupon payments, and the potential for capital gains or losses, leading to an incomplete and potentially unsuitable recommendation. The professional decision-making process for similar situations should involve a systematic evaluation of all relevant bond features. This includes understanding the definitions and implications of coupon rate, par value, maturity date, yield to maturity, call provisions, put provisions, and sinking funds. The representative must then connect these features to the client's specific investment objectives, risk tolerance, and time horizon. A thorough analysis of YTM, considering the impact of call or put provisions, is crucial for providing accurate and suitable investment advice. Transparency and clear communication about all potential risks and rewards are paramount to maintaining compliance and ethical standards. Question 6. Investigation of a client's inquiry regarding strategies to consistently outperform the market. A securities representative is considering how to explain the implications of the efficient market hypothesis. Which of the following approaches best reflects an understanding of the semi-strong form of the EMH and its impact on investment advice? Option A. Stating that insider information is the only way to consistently beat the market. Option B. Advising the client that while thorough analysis of public financial data and news is important for understanding a company, it is unlikely to provide a consistent edge for outperforming the market. Option C. Asserting that all market participants, including institutional investors, are incapable of outperforming the market, regardless of their analytical capabilities or access to information. Option D. Suggesting that by meticulously analyzing publicly available financial statements and news articles, the client can consistently identify undervalued securities and achieve superior returns. The correct answer is B. Advising the client that while thorough analysis of public financial data and news is important for understanding a company, it is unlikely to provide a consistent edge for outperforming the market. Explanation. This scenario presents a professional challenge because it requires a securities representative to interpret market behavior and advise clients based on a theoretical framework, the efficient market hypothesis, M. The challenge lies in applying these abstract concepts to real-world investment decisions and understanding the implications of each form of EMH for client advice, particularly concerning the potential for alpha generation and the reliance on publicly available information. Careful judgment is required to distinguish between the informational assumptions of each EMH form and their practical consequences for investment strategies. The correct approach involves recognizing that if markets are semi-strong form efficient, then all publicly available information is already reflected in stock prices. This implies that strategies relying solely on analyzing public financial statements, news releases, or analyst reports are unlikely to consistently generate abnormal returns. A representative adhering to this understanding would advise clients that while diligent research into public information is valuable for understanding a company, it is unlikely to provide a sustainable edge for outperforming the market. This aligns with regulatory expectations for providing realistic and well-founded investment advice, avoiding claims of guaranteed outperformance based on readily accessible data. An incorrect approach would be to suggest that by meticulously analyzing publicly available financial statements and news articles, A client can consistently identify undervalued securities and achieve superior returns. This approach fails to acknowledge the semi-strong form efficiency of markets, where such information is already priced in. The regulatory failure here is misrepresenting the potential for profit from readily available information, potentially leading clients to pursue strategies that are unlikely to succeed and could result in underperformance. Another incorrect approach would be to claim that insider information is the only way to consistently beat the market. While insider trading is illegal and unethical, this statement incorrectly implies that without such illegal activity, consistent outperformance is impossible, even with superior analytical skills applied to public information. This misrepresents the potential for skilled active management within the bounds of legality and ethics, and it also skirts dangerously close to discussing illegal activities, which is a significant ethical and regulatory breach. A further incorrect approach would be to assert that all market participants, including institutional investors with vast resources, are incapable of outperforming the market, regardless of their analytical capabilities or access to information. This oversimplifies the EMH and ignores the possibility that even in efficient markets, skilled managers might, through superior strategy, risk management, or access to proprietary, non-public, but legal information, achieve some level of outperformance, albeit potentially small and inconsistent. The regulatory failure lies in providing an overly deterministic and potentially misleading view of market dynamics that could discourage legitimate and potentially effective investment strategies. The professional decision-making process for similar situations should involve 1. Understanding the client's investment objectives and risk tolerance. 2. Evaluating the client's capacity for research and analysis. 3. Explaining the relevant theoretical frameworks, such as EMH, in clear, understandable terms. 4. Discussing the practical implications of these theories for different investment strategies, emphasizing realistic expectations regarding returns and the role of public versus private information. 5. Recommending strategies that are consistent with the client's profile and the prevailing market conditions, always adhering to ethical standards and regulatory requirements. Question 7. Quality control measures reveal that a registered representative, when asked by a client about a specific company's ability to meet its upcoming financial obligations, provided an analysis based on a ratio that measures how effectively the company utilizes its assets to generate sales. Which financial ratio was most likely used, and why is this approach problematic in addressing the client's stated concern? Option A. An efficiency ratio, such as the inventory turnover ratio or accounts receivable turnover ratio. Option B. A solvency ratio, such as the debt-to-equity ratio or interest coverage ratio. Option C. A profitability ratio, such as the net profit margin or return on equity. Option D. A liquidity ratio, such as the current ratio or quick ratio. The correct answer is D. A liquidity ratio, such as the current ratio or quick ratio. Explanation. This scenario presents a professional challenge because it requires a registered representative to interpret financial data and provide advice based on that interpretation, all while adhering to regulatory standards designed to protect investors. The core difficulty lies in moving beyond simple calculation to understanding the implications of financial ratios within the context of a client's investment objectives and risk tolerance, and doing so without making misleading statements or recommendations. The representative must demonstrate a nuanced understanding of how different ratios inform an investment decision, and how to communicate these insights effectively and ethically. The correct approach involves selecting the financial ratio that most directly addresses the client's stated concern about the company's ability to meet its short-term obligations. This demonstrates a focused and relevant analysis, prioritizing the client's immediate needs and understanding of financial health. Regulatory frameworks, such as those overseen by FINRA for the Series 62 exam, emphasize the importance of suitability and providing accurate, non-misleading information. By choosing a liquidity ratio, the representative is directly addressing a key aspect of a company's operational stability that impacts its ability to function and meet its debts, which is crucial for investor confidence and risk assessment. This aligns with the ethical obligation to act in the client's best interest and provide advice that is grounded in a sound understanding of the company's financial position relevant to the client's inquiry. An incorrect approach would be to select a profitability ratio. While profitability is important for long-term investment success, it does not directly answer the client's specific question about the company's ability to pay its bills in the near future. Focusing on profitability without addressing the liquidity concern could lead the client to believe the company is financially sound in the short term when it may not be, creating a misleading impression and potentially violating regulations against misrepresentation. Another incorrect approach would be to select a solvency ratio. Solvency ratios, like liquidity ratios, assess a company's ability to meet its obligations, but they typically focus on longer-term debt. While related, they are not as precise as liquidity ratios in addressing the immediate concern of short-term debt repayment. Providing a solvency ratio in response to a question about immediate obligations could be seen as not fully addressing the client's specific concern, potentially leading to a misunderstanding of the company's immediate financial stability. Finally, selecting an efficiency ratio would also be an incorrect approach. Efficiency ratios measure how well a company is utilizing its assets to generate revenue. While important for overall performance, they do not directly speak to the company's ability to meet its short-term financial obligations, which was the client's explicit concern. Focusing on efficiency would be a misdirection, failing to provide the client with the specific information they requested and potentially leading to an inappropriate investment decision based on incomplete analysis. The professional decision-making process for similar situations should involve: first, carefully identifying the client's specific question and underlying concern. Second, recalling the definitions and applications of various financial ratios. Third, selecting the ratio that most directly and accurately addresses the client's stated need. And fourth, being prepared to explain the chosen ratio and its implications clearly and concisely, while also considering other relevant ratios if appropriate for a more comprehensive understanding, but always prioritizing the direct answer to the client's inquiry. Question 8. Compliance review shows that a registered representative, when discussing corporate debt instruments with a potential client, described a debenture as a type of bond that is secured by specific company assets. Which of the following classifications accurately describes a debenture? Option A, a bond that is exclusively investment grade. Option B, a secured bond backed by specific company assets. Option C, a bond that is always considered high yield. Option D, an unsecured bond backed by the issuer's general creditworthiness. The correct answer is D, an unsecured bond backed by the issuer's general creditworthiness. Explanation: this scenario is professionally challenging because it requires a registered representative to accurately distinguish between different types of corporate bonds and understand their implications for investors, particularly concerning risk and collateral. A failure to do so could lead to misrepresenting investment products, potentially violating suitability rules and fiduciary responsibilities under SEC regulations and FINRA rules applicable to the Series 62 exam. The representative must demonstrate a nuanced understanding of bond structures and credit quality to provide appropriate guidance. The correct approach involves correctly identifying that a debenture is an unsecured bond, meaning it is backed only by the issuer's general creditworthiness and not by specific collateral. This understanding is crucial for advising clients on the relative risk profiles of different debt instruments. Regulatory frameworks, such as those enforced by the SEC and FINRA, emphasize the importance of accurate product knowledge and fair dealing. Providing accurate information about the unsecured nature of a debenture aligns with the duty to ensure that investment recommendations are suitable for the customer's financial situation and investment objectives. An incorrect approach would be to classify a debenture as a secured bond. This is a fundamental misunderstanding of the definition of a debenture. Secured bonds are backed by specific assets of the issuer, offering a higher degree of protection to bondholders in the event of default. Representing a debenture as secured would be a direct violation of regulations requiring accurate and truthful representation of securities. Another incorrect approach would be to assume that all unsecured bonds are inherently high yield. While many high-yield bonds are unsecured, the terms are not synonymous. Investment-grade bonds can also be unsecured. Confusing these categories demonstrates a lack of precise knowledge about bond classifications and their associated risk and return characteristics, which is essential for compliance. A further incorrect approach would be to equate debentures solely with investment-grade bonds. Debentures can be either investment-grade or high-yield, depending on the issuer's credit rating. This oversimplification fails to capture the full spectrum of risk associated with debentures and could lead to inappropriate recommendations. Professionals should approach such situations by first recalling the precise definitions of each bond type, focusing on the presence or absence of collateral and the issuer's creditworthiness. They should then consider how these characteristics translate into risk and potential return for an investor. When advising clients, it is imperative to clearly articulate these distinctions and ensure that the client understands the specific features and risks of any recommended security. This process aligns with the principles of fair dealing and suitability mandated by securities regulations. Question 9. When evaluating convertible bonds for a client, which of the following best describes the fundamental characteristic that allows the bondholder to benefit from an increase in the issuer's common stock price? Option A. The bond's par value increases in proportion to the stock's appreciation. Option B. The bond's coupon rate adjusts upward if the stock price rises. Option C. The bond can be exchanged for a specified number of shares of the issuer's common stock. Option D. The bond's maturity date is extended if the stock price performs well. The correct answer is B. The bond's coupon rate adjusts upward if the stock price rises. Explanation. This scenario is professionally challenging because it requires a registered representative to accurately explain the features of convertible securities to a client, ensuring the client understands both the potential benefits and inherent risks. Misrepresenting or oversimplifying these features can lead to client dissatisfaction, regulatory scrutiny, and potential financial harm to the investor. The representative must navigate the complexities of conversion ratios and prices in a way that is clear and compliant with Series 62 exam standards, which emphasize investor protection and fair dealing. The correct approach involves clearly articulating that a convertible bond can be exchanged for a predetermined number of shares of the issuing company's common stock. This exchange is governed by the conversion ratio, the number of shares received per bond, and the conversion price, the effective price per share at which the conversion occurs. The primary benefit for the investor is the potential to participate in the upside appreciation of the underlying stock while retaining the relative safety of a bond's fixed income payments and principal repayment. The risk lies in the possibility that the stock price may not rise sufficiently to make conversion profitable, or that the issuer could default on the bond payments. This approach accurately reflects the dual nature of convertible bonds and aligns with the Series 62 exam's focus on ensuring investors understand the products they are purchasing. An incorrect approach would be to focus solely on the potential for stock appreciation, without adequately explaining the conversion mechanics or the risks associated with the bond itself. This misrepresents the product by omitting crucial details about how conversion works and the downside protection offered by the bond component. Another incorrect approach would be to emphasize the fixed income aspect of the bond, while downplaying or ignoring the conversion feature and its associated equity risk. This misleads the client by presenting the security as purely a debt instrument, failing to disclose the potential for equity-like volatility and the impact of stock price movements on the bond's value and the attractiveness of conversion. A third incorrect approach might involve using overly technical jargon without providing clear, client-friendly explanations of terms like conversion ratio and conversion price, thereby failing to ensure client comprehension and potentially violating suitability standards. Professionals should approach such situations by prioritizing client education and transparency. This involves understanding the product thoroughly, anticipating client questions, and explaining complex features in simple, understandable terms. A systematic process would involve 1. Identifying the core features of the security, e.g., debt component equity conversion option. 2. Explaining the mechanics of the conversion feature, ratio, price, and how they interact with the stock price. 3. Clearly outlining the potential benefits, upside participation, income and risks, default, stock underperformance, loss of principal. 4. Ensuring the client understands these elements before proceeding, in accordance with suitability and fair dealing principles. Question 10. Stakeholder feedback indicates that clients often misunderstand the relationship between bond credit ratings and their market value. When discussing a corporate bond with a recent downgrade in its credit rating, which of the following best describes how a registered representative should explain the potential impact on the bond's price and yield, adhering to Series 62 exam regulations? Option A. Emphasize that the bond's yield will decrease because investors will be more willing to buy it at a lower yield due to the perceived increased safety. Option B. State that a downgrade will definitively cause the bond's price to fall and its yield to rise, as the market will react negatively. Option C. Advise the client that a downgraded bond is now a speculative investment and should be avoided by all investors. Option D. Explain that a downgrade generally increases the perceived risk of the bond, which typically leads to a decrease in its price and an increase in its yield to compensate investors for the higher risk. The correct answer is D. Explain that a downgrade generally increases the perceived risk of the bond, which typically leads to a decrease in its price and an increase in its yield to compensate investors for the higher risk. Explanation. This scenario is professionally challenging because it requires a registered representative to interpret and apply information about bond ratings to advise a client, while adhering strictly to the regulatory framework governing the Series 62 exam. The challenge lies in understanding how credit ratings influence bond prices and yields, and then translating this understanding into actionable, compliant advice. A representative must avoid making definitive predictions or guarantees, and instead focus on educating the client about the general relationship between ratings and market behavior. The correct approach involves explaining to the client that higher credit rating generally signifies lower risk, and consequently, typically leads to lower yields and higher prices for a bond, assuming all other factors are equal. Conversely, a lower credit rating indicates higher risk, which usually results in higher yields and lower prices to compensate investors for that increased risk. This explanation aligns with the principles of fair dealing and suitability, as it provides the client with factual information to understand potential investment characteristics without making specific recommendations or predictions that could be construed as guarantees. The regulatory framework for the Series 62 exam emphasizes the importance of providing accurate and balanced information to clients. An incorrect approach would be to suggest that a downgrade in a bond's rating will always cause its price to fall significantly, or that an upgrade will always cause its price to rise substantially. This is an oversimplification and potentially misleading, as bond prices are influenced by numerous factors beyond credit ratings, including interest rate changes, market sentiment, and the specific terms of the bond. Such a statement could be interpreted as a guarantee or a prediction of future performance, which is prohibited. Another incorrect approach would be to state that a bond with a lower rating is always a bad investment. This is a subjective judgment and fails to acknowledge that higher yields on lower-rated bonds may be appropriate for certain investors with a higher risk tolerance and specific investment objectives. This approach lacks objectivity and could lead to unsuitable recommendations. Finally, focusing solely on the yield without mentioning the associated risk, or vice versa, presents an incomplete picture and fails to educate the client adequately on the trade-offs involved, potentially violating the duty to provide full and fair disclosure. Professionals should approach such situations by first understanding the client's risk tolerance, investment objectives, and financial situation. Then, they should explain the general principles of how credit ratings impact bond characteristics, using clear and objective language. They must avoid making specific predictions about price movements or labeling investments as inherently good or bad. The focus should always be on educating the client and facilitating informed decision-making, consistent with regulatory requirements for fair dealing and suitability. Question 11. Analysis of a client's stated investment objectives reveals a desire for significant capital appreciation over a long-term horizon, with a stated comfort level for moderate short-term fluctuations in portfolio value. The client is not seeking current income. Which investment strategy would be most appropriate to recommend, considering the client's profile and regulatory requirements for suitability? Option A. A balanced approach heavily weighted towards income-generating assets. Option B. Value investing. Option C. Growth investing. Option D. Income investing. Correct answer is C. Growth investing. Explanation. This scenario is professionally challenging because it requires a registered representative to align investment strategies with a client's stated objectives and risk tolerance, while adhering to FINRA regulations regarding suitability. The representative must understand the core principles of each investment approach and how they relate to different investor profiles. The correct approach is to recommend growth investing because the client explicitly seeks capital appreciation and has a long-term investment horizon, indicating a higher tolerance for short-term volatility. This aligns with the fundamental tenets of growth investing, which focuses on companies expected to grow earnings and revenues at an above-average rate compared to their industry or the overall market. FINRA Rule 2111, Suitability, mandates that a broker-dealer or associated person must have a reasonable basis to believe that a recommended investment or investment strategy is suitable for a particular customer based on their investment profile. Recommending growth investing in this context directly addresses the client's stated goals and risk capacity, fulfilling the suitability obligation. Recommending value investing would be incorrect because, while it aims for long-term capital appreciation, it typically focuses on undervalued companies that may be out of favor, potentially leading to a longer realization period for gains and a different risk profile than what the client has indicated. This could be deemed unsuitable if the client's primary concern is aggressive, near-term growth. Recommending income investing would be incorrect because the client's stated objective is capital appreciation, not current income generation. Income investing prioritizes dividends and interest payments, which is contrary to the client's desire for growth. Recommending this strategy would directly contradict the client's stated goals and therefore violate the suitability rule. Recommending a balanced approach that heavily emphasizes income-generating assets would also be incorrect. While a balanced approach can be suitable for many investors, the client's specific emphasis on capital appreciation and a long-term horizon suggests a strategy that can tolerate more risk for potentially higher growth, making a heavily income-focused balanced approach unsuitable. The professional decision-making process for similar situations involves a thorough discovery of the client's financial situation, investment objectives, time horizon, and risk tolerance. This information must be documented. The representative then analyzes various investment strategies and specific investment products to determine which best fit the client's profile, always prioritizing the client's best interests and adhering to FINRA suitability and fair dealing rules. The representative must be able to articulate the rationale behind any recommendation, linking it directly to the client's profile and regulatory requirements. Question 12. Benchmark analysis indicates that a recent report shows a significant increase in the Consumer Price Index, CPI. As a Series 62 registered representative, how should you best explain the potential implications of this inflation data to a client who is concerned about their investment portfolio's performance? Option A. Recommend that the client purchase specific growth stocks that are historically known to perform well during inflationary periods, guaranteeing a positive return. Option B. State that the CPI report is irrelevant to individual stock performance and that the client should not be concerned about economic indicators. Option C. Advise the client to immediately sell all their stock holdings because rising inflation will inevitably cause the stock market to decline sharply. Option D. Explain that rising inflation generally leads to increased corporate costs, potentially impacting profit margins and stock valuations, and discuss how this might influence different sectors of the market, while emphasizing that this is not a prediction of future price movements. The correct answer is D. Explain that rising inflation generally leads to increased corporate costs, potentially impacting profit margins and stock valuations, and discuss how this might influence different sectors of the market, while emphasizing that this is not a prediction of future price movements. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to interpret complex economic data and its potential market impact, then advise a client based on that interpretation. The challenge lies in translating broad economic trends into actionable investment insights while adhering to regulatory standards that prohibit making predictions or guarantees about future market performance. A representative must demonstrate a thorough understanding of economic indicators and their relationship to securities markets without overstepping ethical and legal boundaries. Correct approach analysis. The correct approach involves explaining how a specific economic indicator, such as a change in the Federal Reserve's target interest rate, is generally understood to influence corporate borrowing costs and, consequently, corporate profitability and stock valuations. This explanation should be framed as a discussion of historical relationships and general market tendencies, not as a prediction of future stock price movements. This aligns with SEC regulations and FINRA rules that require representatives to provide fair and balanced information, avoid misleading statements, and ensure that recommendations are suitable for the client. The focus is on educating the client about potential market dynamics, empowering them to make informed decisions, rather than dictating a course of action or guaranteeing outcomes. Incorrect approach is analysis. One incorrect approach would be to directly advise the client to buy or sell a specific security based solely on the expectation that a particular economic indicator will cause its price to rise or fall. This constitutes making a prediction or guarantee about future market performance, which is prohibited under SEC Rule 10b-5 and FINRA rules regarding fair dealing with customers. It also fails to consider the client's individual investment objectives, risk tolerance, and financial situation, violating the suitability requirements. Another incorrect approach would be to dismiss the economic indicator entirely, stating that it has no bearing on the market. This demonstrates a lack of understanding of fundamental economic principles and their impact on securities. It fails to provide the client with relevant information that could influence their investment decisions, thus not acting in the client's best interest and potentially violating FINRA duty of care. A third incorrect approach would be to present the economic indicator's potential impact in a highly speculative or exaggerated manner, implying certainty of a specific market reaction. This is misleading and can lead to inappropriate investment decisions by the client, violating the principles of fair dealing and integrity of the market. Professional reasoning. Professionals should approach client discussions about economic indicators by first understanding the client's financial profile and investment goals. They should then explain the general nature and potential impact of relevant economic indicators, drawing on established economic theory and historical market behavior. The discussion should be framed as educational, highlighting potential risks and opportunities without making definitive predictions. Any recommendations must be clearly linked to the client's suitability profile and supported by a reasonable basis. This process ensures compliance with regulatory requirements for suitability, fair dealing, and accurate representation of information. Question 13. Strategic planning requires a registered representative to consider various approaches when discussing the possibility of a client opening a margin account. Which of the following approaches best aligns with regulatory requirements and ethical obligations concerning margin trading? Option A. Highlight the tax advantages of margin interest deductions and downplay the risks associated with margin calls, suggesting they are rare occurrences for active traders. Option B. Assume the client's understanding of margin trading due to their experience in the market and proceed with opening the account with minimal discussion of specific margin rules. Option C. Emphasize the potential for amplified returns and the ability to leverage investments, while briefly mentioning that margin involves borrowing and potential for losses. Option D. Focus on the client's stated desire for aggressive growth and explain the mechanics of initial and maintenance margin, clearly detailing the conditions that trigger a margin call and the consequences of liquidation, while assessing the client's capacity to meet such calls. Correct answer is C. Emphasize the potential for amplified returns and the ability to leverage investments, while briefly mentioning that margin involves borrowing and potential for losses. Explanation. This scenario is professionally challenging because it requires a registered representative to balance the potential benefits of margin trading for a client with the significant risks involved, all while adhering to strict regulatory requirements. Representative must ensure the client fully understands these risks and that the account is suitable. A failure to do so could lead to substantial financial losses for the client and regulatory sanctions for the representative and the firm. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a clear and comprehensive explanation of margin requirements, the potential for margin calls, and the inherent risks of leverage trading. This aligns with the SEC's regulations and FINRA rules, which mandate that firms and their representatives have a duty to know their customer and ensure that recommendations are suitable. Specifically, the Securities Exchange Act of 1934 and associated rules require that customers be fully informed about the risks of margin trading, including the possibility of losing more than their initial investment and the mechanics of margin calls. Ethical considerations also demand that representatives act in the best interest of their clients, which includes preventing them from taking on excessive risk they do not understand or cannot afford. An incorrect approach that focuses solely on the potential for increased returns without adequately disclosing the amplified risks of loss is a direct violation of suitability rules. This failure to provide a balanced perspective misleads the client and exposes them to undue risk. Another incorrect approach that neglects to explain the mechanics and consequences of a margin call, such as the forced liquidation of securities at unfavorable prices, is also a serious regulatory failure. This omission prevents the client from making an informed decision about the potential downsides of margin trading. Furthermore, an approach that assumes the client's sophistication negates the need for explicit disclosures about margin risks is flawed. Regulatory obligations to inform and ensure suitability are not waived by perceived client expertise. Professionals should employ a decision-making framework that prioritizes client protection and regulatory compliance. This involves a systematic process of gathering client information, evaluating account suitability, clearly communicating all associated risks and requirements, and documenting all interactions and decisions. When considering margin accounts, this framework necessitates a detailed discussion of initial margin, maintenance margin, the triggers for margin calls, and the potential for rapid and significant losses. The representative must ensure the client comprehends these concepts and agrees to the terms, demonstrating a clear understanding of their responsibilities and the risks involved. Question 14. Research into a client's retirement planning needs reveals that they are primarily concerned with generating a stable, predictable income stream in retirement. They have expressed a strong interest in products that can provide this security. As a registered representative, what is the most appropriate initial step to take when considering retirement planning solutions for this client? Option A. Advise the client to explore options for immediate annuities, focusing on the highest current payout rates available in the market. Option B. Recommend a fixed annuity that offers a guaranteed income stream, emphasizing its tax-deferred growth and predictable payout options. Option C. Suggest investing in a diversified portfolio of dividend-paying stocks and bonds to generate income, highlighting the potential for capital appreciation. Option D. Discuss the client's overall financial situation, including their risk tolerance, liquidity needs, time horizon to retirement, and tax bracket, before presenting any specific product recommendations. The correct answer is B. Recommend a fixed annuity that offers a guaranteed income stream, emphasizing its tax-deferred growth and predictable payout options. Explanation. This scenario is professionally challenging because a registered representative must balance the client's immediate desire for income with the long-term implications of retirement planning, particularly concerning tax implications and the potential for future growth. The representative must ensure that any recommendation aligns with the client's stated goals and risk tolerance, while also adhering to regulatory requirements designed to protect investors. Careful judgment is required to avoid making recommendations that could be detrimental to the client's financial well-being in retirement. The correct approach involves a thorough assessment of the client's overall financial situation, retirement goals, and risk tolerance before recommending any specific retirement product. This includes understanding the tax implications of different retirement vehicles and ensuring the chosen product is suitable for the client's needs. For instance, recommending an annuity without fully understanding the client's need for liquidity or potential tax liabilities upon withdrawal would be inappropriate. The representative must act in the client's best interest, a core principle under FINRA rules, which emphasizes suitability. This means the recommendation must be based on a comprehensive understanding of the client's circumstances and the features of the product. An incorrect approach would be to recommend a product solely based on its income-generating potential, without considering the client's broader financial picture or the product's limitations. For example, recommending a deferred annuity solely because it offers a guaranteed income stream, without discussing the surrender charges, tax treatment of withdrawals, or the client's need for access to funds before annuitization, would be a regulatory failure. This violates the suitability rule, as the recommendation is not tailored to the client's specific needs and circumstances. Another incorrect approach would be to push a product that offers higher commissions to the representative, regardless of its suitability for the client. This constitutes a conflict of interest and a violation of ethical standards and FINRA rules regarding fair dealing with customers. Recommending a product that the representative does not fully understand, or misrepresenting its features or risks, is also a significant ethical and regulatory breach. The professional decision-making process for similar situations should begin with a deep dive into the client's financial profile, including income, expenses, assets, liabilities, and retirement objectives. This should be followed by a clear explanation of various retirement planning options, including their benefits, risks, and tax implications. The representative must then match the client's profile and goals with the most suitable product, ensuring full disclosure of all relevant information. If a client expresses a strong preference for a particular product, the representative must still conduct a thorough suitability analysis and explain any potential drawbacks or alternative options. Question 15. Operational review demonstrates that a registered representative has recommended a corporate bond to a client. The bond has undergone the firm's internal new product review and has been approved for sale. The representative believes the bond's yield is attractive, but has not independently verified if the bond's specific risk profile aligns with the client's stated conservative investment objectives and limited experience with fixed-income securities. Which of the following represents the most appropriate course of action for the registered representative? Option A. Proceed with the recommendation, as the firm's internal approval signifies that the product meets regulatory standards and is suitable for clients. Option B. Conduct a thorough assessment of the bond's specific risks, liquidity, and maturity, and compare these factors against the client's investment objectives, risk tolerance, and financial situation before making a recommendation. Option C. Decline to make the recommendation and inform the client that the firm's internal review process is not sufficient to meet their specific needs. Option D. Recommend the bond, but advise the client to consult with an independent financial advisor to confirm its suitability. Correct answer is A. Proceed with the recommendation, as the firm's internal approval signifies that the product meets regulatory standards and is suitable for clients. Explanation. This scenario is professionally challenging because it requires a registered representative to balance the firm's internal policies with the overarching regulatory obligations under the Securities Exchange Act of 1934 and FINRA rules, specifically concerning the suitability of investments for customers. The representative must understand that, while a firm may have internal guidelines, these do not supersede federal securities laws and self-regulatory organization rules. The core of the challenge lies in discerning when a firm's internal process, even if seemingly robust, might lead to a violation of the duty of care owed to a customer. The correct approach involves recognizing that the firm's internal review process, while a component of due diligence, is not the sole determinant of suitability. A registered representative has an independent obligation to ensure that any recommendation made is suitable for the customer based on their investment objectives, risk tolerance, financial situation, and needs. This aligns with the fundamental principles of investor protection embedded in the Securities Exchange Act of 1934 and FINRA Rule 2111, suitability. The representative must actively assess the investment's fit for the specific client, even if it has passed internal scrutiny. An incorrect approach would be to solely rely on the firm's internal approval, assuming it absolves the representative of their personal responsibility. This fails to acknowledge the representative's direct duty to the client and the potential for internal processes to be flawed or incomplete. It also represents a failure to exercise independent judgment, which is a cornerstone of ethical conduct in the securities industry. Another incorrect approach is to proceed with the recommendation without thoroughly understanding the investment's characteristics and how they align with the client's profile, even if the firm's approval is obtained. This demonstrates a lack of diligence and a disregard for the client's best interests, potentially violating the duty of care. Finally, an approach that prioritizes the firm's desire to execute a transaction over the client's suitability is a clear ethical and regulatory breach, prioritizing business objectives above investor protection. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's profile. This understanding should then be used to evaluate any proposed investment, regardless of internal firm approvals. If there is any doubt about suitability, the representative must seek further information, consult with supervisors, or decline to make the recommendation. The ultimate responsibility for ensuring suitability rests with the registered representative. Question 16. Comparative studies suggest that, while multiple methods exist for valuing corporate securities, the most appropriate technique can vary significantly depending on the company's characteristics and the purpose of the valuation. A registered representative is asked by a client to provide a valuation for a privately held technology startup that is not yet profitable, but has significant intellectual property and a projected rapid growth trajectory. The representative is considering using the average price-to-earnings P/E multiples of publicly traded, mature software companies as the primary valuation method. Which of the following approaches best reflects sound professional judgment and regulatory compliance in this scenario? Option A. Using the average price-to-earnings P/E multiples of publicly traded, mature software companies to value the startup, assuming its future performance will align with these established companies. Option B. Employing a discounted cash flow (DCF) analysis, projecting future cash flows based on reasonable growth assumptions, and then discounting them back to present value, while acknowledging the inherent uncertainties in startup projections. Option C. Relying solely on the book value of the startup's tangible assets as the basis for valuation, as this represents a concrete and verifiable measure of worth. Option D. Applying a liquidation value approach, assuming the company would be sold off in pieces if it failed to achieve profitability. The correct answer is B. Employing a discounted cash flow (DCF) analysis, projecting future cash flows based on reasonable growth assumptions, and then discounting them back to present value, while acknowledging the inherent uncertainties in startup projections. Explanation. This scenario presents a professional challenge because a registered representative is asked to provide a valuation for a security without a clear, universally applicable method. The representative must exercise sound judgment to select an appropriate valuation technique that aligns with regulatory expectations and ethical obligations to clients. The challenge lies in the potential for subjective interpretation and the need to ensure the chosen method is defensible and not misleading. The correct approach involves using a valuation method that is appropriate for the specific security and the context of the valuation, considering factors like the company's stage of development, industry, and available financial data. Discounted cash flow (DCF) is often considered a robust method when reliable projections of future cash flows can be made, as it attempts to capture the intrinsic value of an asset based on its expected future earnings. Relative valuation, using multiples from comparable companies, is also a valid approach, particularly for mature companies in established industries where comparable data is readily available. Asset-based valuation is most suitable for companies with significant tangible assets or those undergoing liquidation. The key is to select a method that is supported by evidence and reasonable assumptions, and to disclose the methodology and its limitations to the client. This aligns with FINRA Rule 2111, Suitability, which requires recommendations to be suitable based on the customer's investment profile, and the general ethical obligation to act with diligence and care. Using only relative valuation without considering the specific company's unique characteristics or future prospects can be an incorrect approach. This method relies heavily on market comparisons, which may not accurately reflect the intrinsic value of a company if the comparable companies are not truly similar or if the market is mispricing those comparables. This could lead to a recommendation that is not suitable for the client. Similarly, relying solely on asset-based valuation for a growth company with significant intangible assets would be inappropriate and could result in a misleading valuation, failing to capture the company's true potential and thus violating suitability obligations. Employing a valuation method without understanding its underlying assumptions or without the ability to justify those assumptions to a client is also ethically problematic, as it suggests a lack of diligence and expertise. Professionals should approach valuation by first understanding the nature of the security and the purpose of the valuation. They should then consider the most appropriate valuation methodologies given the available information and the characteristics of the security. Transparency with the client regarding the chosen method, the assumptions made, and any limitations of the valuation is paramount. If a specific method is requested by a client, the representative should assess its appropriateness and explain any potential shortcomings. Question 17. The control framework reveals that a publicly traded corporation has acquired new machinery for its primary manufacturing plant. This acquisition was funded by a portion of the company's retained earnings. According to U.S. GAAP, how should this transaction be categorized on the company's statement of cash flows? Option A, operating activities. Option B, supplemental disclosures. Option C, financing activities. Option D, investing activities. The correct answer is D, investing activities. Explanation. This scenario is professionally challenging because it requires a representative to accurately categorize cash flows based on their underlying economic substance, not just their superficial appearance. Misclassifying cash flows can lead to a distorted understanding of a company's financial health and operational efficiency, potentially misleading investors and impacting investment decisions. The representative must demonstrate a thorough understanding of the distinctions between operating, investing, and financing activities as defined by U.S. Generally Accepted Accounting Principles, GAAP, which are the governing standards for the Series 62 exam. The correct approach involves identifying that the purchase of new equipment for the company's manufacturing operations is a direct investment in its productive capacity. This falls squarely under investing activities, as it involves the acquisition of long-term assets used in generating revenue. U.S. GAAP explicitly defines investing activities as those involving the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Therefore, classifying this transaction as an investing activity is consistent with regulatory requirements and best accounting practices. An incorrect approach would be to classify the purchase of new equipment as an operating activity. This is a failure because operating activities primarily relate to the core revenue-generating operations of the business, such as sales of goods or services, and the expenses incurred to generate that revenue. While equipment is used in operations, its acquisition is a capital expenditure, not a day-to-day operational expense. This misclassification would inflate the perceived cash generated from core operations. Another incorrect approach would be to classify the purchase of new equipment as a financing activity. Financing activities involve transactions that affect the debt and equity of the company, such as issuing stock, repurchasing shares, or taking out loans. The purchase of equipment does not directly alter the company's capital structure. Misclassifying it as financing would incorrectly suggest that the company is raising capital or repaying debt through this transaction. A final incorrect approach would be to exclude the purchase of new equipment from the cash flow statement altogether. This is a significant regulatory failure, as all significant cash inflows and outflows must be reported. The cash flow statement's purpose is to provide a comprehensive view of a company's cash movements, and omitting a substantial capital expenditure would render the statement incomplete and misleading. Professionals should approach such situations by first understanding the fundamental purpose of each section of the cash flow statement: operating day-to-day business, investing long-term assets and investments, and financing debt and equity. They should then analyze the economic substance of the transaction. If the transaction involves acquiring or disposing of assets that will be used for more than 1 year to generate revenue, it is likely an investing activity. If it involves raising or repaying capital, it's financing. If it relates to the core production and sale of goods or services, it's operating. When in doubt, consulting authoritative accounting guidance, such as fast pronouncements, is crucial. Question 18. Regulatory review indicates that a registered representative is advising a client on a potential investment in a publicly traded technology company. The representative has reviewed the company's latest annual report, which includes the balance sheet, income statement, and cash flow statement. The client has expressed interest in the company's growth potential, but is also concerned about its financial stability. Which of the following approaches best demonstrates the representative's adherence to regulatory requirements and professional conduct in advising the client? Option A. The representative provides the client with copies of the balance sheet, income statement, and cash flow statement, explaining that the client should review these documents to form their own opinion about the company's financial health. Option B. The representative focuses on the company's market capitalization and recent stock price performance, asserting that positive market sentiment is the primary indicator of a sound investment. Option C. The representative highlights the significant increase in the company's revenue reported on the income statement and suggests that this growth trend is indicative of a strong future investment. Option D. The representative analyzes the trends across all 3 financial statements, considering the company's debt-to-equity ratio, operating cash flow, and net income, and then discusses both the growth opportunities and potential financial risks with the client in a balanced manner. The correct answer is C. The representative highlights the significant increase in the company's revenue reported on the income statement and suggests that this growth trend is indicative of a strong future investment. Explanation: this scenario is professionally challenging because it requires a representative to interpret complex financial information and apply it to a client's investment decision-making process, all while adhering to strict regulatory guidelines designed to protect investors. The representative must move beyond simply presenting data to providing insightful analysis that is both accurate and suitable for the client's understanding and risk tolerance. The core challenge lies in translating the nuances of financial statements into actionable investment advice without making misleading statements or recommendations. The correct approach involves a thorough analysis of the company's financial statements, focusing on trends, ratios, and qualitative factors that indicate the company's financial health and future prospects. This analysis should then be communicated to the client in a clear, concise, and understandable manner, highlighting both the potential benefits and risks associated with an investment. This approach aligns with FINRA Rule 2111, suitability, which mandates that a broker-dealer must have a reasonable basis to believe that a recommended investment or strategy is suitable for a particular customer based on the customer's investment objectives, risk tolerance, and financial situation. It also upholds the principles of fair dealing and good faith expected of registered representatives. An incorrect approach would be to solely focus on a single positive metric from one financial statement, such as a recent increase in revenue on the income statement, without considering other crucial aspects like debt levels on the balance sheet or cash flow generation. This failure to conduct a holistic analysis violates the suitability rule by potentially overlooking significant risks. Another incorrect approach would be to present raw financial data to the client without any interpretation or context, leaving the client to make their own, potentially uninformed decisions. This abdicates the representative's responsibility to provide informed guidance and could be seen as a failure to act in the client's best interest. Finally, making overly optimistic projections based on limited data, without acknowledging potential downsides or uncertainties, constitutes a misrepresentation and a violation of the duty of fair dealing. The professional reasoning process for such situations should involve a systematic evaluation of the company's financial health using all available financial statements. This includes assessing profitability, liquidity, solvency, and operational efficiency. The representative must then synthesize this information into a clear narrative that addresses the client's specific needs and risk profile. If the analysis reveals potential red flags or significant risks, these must be clearly communicated to the client. The representative should always err on the side of caution and transparency, ensuring that the client has a complete and accurate understanding of the investment before making any decision. Question 19. Consider a scenario where a client owns 100 shares of XYZ stock, currently trading at $50 per share. The client expresses a desire to generate additional income from these shares and indicates they would be comfortable selling the stock if it were to rise to $55 per share. The client has a neutral to slightly bullish outlook on XYZ stock for the next few months. Which of the following option strategies would be most appropriate for this client? Option A. Buy one XYZ put option with a strike price of $45 expiring in 3 months. Option B. Sell one XYZ call option with a strike price of $55 expiring in 3 months. Option C. Sell one XYZ call option with an unlimited strike price expiring in 3 months. Option D. Sell one XYZ straddle, consisting of a call and a put option with the same strike price, expiring in 3 months. The correct answer is B. Sell one XYZ call option with a strike price of $55, expiring in 3 months. Explanation. This scenario presents a professional challenge because it requires a registered representative to understand and apply complex option strategies in a way that aligns with client objectives and regulatory requirements. The core difficulty lies in accurately assessing the client's risk tolerance, investment goals, and market outlook to recommend an appropriate option strategy, while also ensuring compliance with FINRA rules regarding suitability and fair dealing. A representative must go beyond simply explaining how a strategy works and instead focus on whether it is a suitable recommendation for the specific client. The correct approach involves recommending a covered call strategy when the client has a neutral to slightly bullish outlook on a stock they already own, and their primary goal is to generate additional income from their existing holdings while being willing to sell the stock at a slightly higher price. This strategy is correct because it directly addresses the client's stated objectives of income generation and their willingness to cap upside potential in exchange for that income. From a regulatory perspective, this aligns with FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a particular customer based on the customer's investment profile. The representative has assessed the client's goals, income generation, risk tolerance, willingness to sell at a higher price, and market view neutral to slightly bullish, making the covered call a suitable recommendation. An incorrect approach would be to recommend a protective put strategy. This strategy is designed to hedge against downside risk for a stock the client already owns, which is contrary to the client's stated goal of generating income and their neutral to slightly bullish outlook. Recommending this would fail to align with the client's investment profile and objectives, violating the suitability rule. Another incorrect approach would be to recommend selling a naked call. This strategy involves significant, potentially unlimited risk, and is only suitable for highly sophisticated investors with a very bearish outlook and substantial capital to cover potential losses. Recommending this to a client seeking income from existing holdings and with a neutral to slightly bullish view would be a severe violation of suitability and fair dealing, exposing the client to unacceptable risk. Finally, recommending a straddle strategy would also be inappropriate. A straddle is a volatility play, typically used when a client expects a significant price movement but is unsure of the direction. This does not align with the client's neutral to slightly bullish outlook or their primary goal of income generation from existing stock. Recommending a straddle would fail to meet the client's specific needs and risk profile. The professional decision-making process for similar situations should begin with a thorough understanding of the client's investment profile, including their financial situation, investment objectives, risk tolerance, and time horizon. The representative must then evaluate how various option strategies align with these factors. The focus should always be on the client's best interest and regulatory compliance, ensuring that any recommendation is suitable and that the client fully understands the risks and potential rewards of the proposed strategy. Question 20. Process analysis reveals that a client is considering an investment in preferred stock and has asked for clarification on its dividend features. Which of the following descriptions most accurately distinguishes a key benefit of cumulative preferred stock compared to non-cumulative preferred stock? Option A. Cumulative preferred stock offers a higher dividend rate than non-cumulative preferred stock. Option B. Cumulative preferred stock has priority over common stock for current dividends only. Option C. Cumulative preferred stock guarantees that all past due dividends will be paid to preferred shareholders before any dividends are paid to common shareholders. Option D. Cumulative preferred stock allows preferred shareholders to receive dividends in proportion to common shareholders' dividends. The correct answer is C. Cumulative preferred stock guarantees that all past due dividends will be paid to preferred shareholders before any dividends are paid to common shareholders. Explanation. This scenario presents a professional challenge because a registered representative must accurately explain the features of preferred stock to a client, ensuring the client understands the implications of each feature for their investment. Misrepresenting or failing to adequately explain these features can lead to client dissatisfaction, regulatory violations, and potential financial harm to the investor. The Series 62 exam emphasizes the representative's responsibility to understand and communicate the nuances of securities products. The correct approach involves clearly differentiating between cumulative and non-cumulative preferred stock. Cumulative preferred stock offers a significant advantage to investors as it ensures that any missed dividend payments must be paid out to preferred shareholders before common shareholders receive any dividends. This feature provides a greater degree of income security and predictability, which is a key characteristic that a representative must convey. This aligns with the regulatory requirement to provide accurate and complete information to clients, enabling them to make informed investment decisions. An incorrect approach would be to describe cumulative preferred stock as simply having a priority for dividends without specifying the obligation to make up missed payments. This is a failure to provide a complete and accurate description, potentially misleading the client about the security of their dividend income. Another incorrect approach would be to equate the dividend priority of cumulative preferred stock with the dividend rights of common stock, which are entirely discretionary and paid only after preferred dividends. This misrepresents the fundamental difference in dividend treatment and the contractual nature of preferred stock dividends. Finally, Failing to mention the cumulative feature at all when discussing preferred stock would be a significant omission, leaving the client unaware of a critical benefit that distinguishes it from non-cumulative preferred stock. Professional decision-making in such situations requires a thorough understanding of the product's features and a commitment to clear, accurate, and comprehensive client communication. Representatives must anticipate client questions and proactively explain the implications of each feature, such as the protective nature of cumulative dividends, the potential for increased returns with participating preferred stock, or the trade-offs associated with convertible and callable features. The focus should always be on enabling the client to make an informed decision based on a complete understanding of the investment's characteristics and risks.